Small business financing refers to the means by which an aspiring or current business owner obtains money to start a new small business, purchase an existing small business, or bring money into an existing small business to finance current or future business activity. The following is a presentation from Mr. Orin James, branch manager of Citizens Bank in Brooklyn.
Welcome to Business Matters, a presentation of the Chamber Coalition, which comprises the New American Chamber of Commerce, the African American International Chamber of Commerce, and the Hispanic American International Chamber of Commerce. To become a chamber member, be a guest, or register for our events, go to www.nacc.nyc. That's www.nacc.nyc, or call us at 718-722-9217. That's 718-722-9217.
Basically, the 5 C's of credit are considered by any lender when making a credit decision. And number 1 is capacity. Do you have the ability to pay back your debts? It's just that simple. We want to know, if we lend you this money, are you going to pay us back? Because ultimately, the bank's in business to make money, and we don't make money when the people that borrow those funds don't pay them back. The other C is capital, and capital from our perspective is the funds that you have personally invested in your business, and that includes profits and money that you've retained. So we want to know what kind of capital you have. Are you invested in your business? The term that we use in the industry is skin in the game, right? We want to make sure that you believe in this business enough to put your money where your mouth is or where your ideas are. And so if you don't believe in it and you're not putting in your capital, then it's tough to convince someone else to put in theirs. The next C is collateral, and any personal or business asset that the lender can take in case you cannot pay the debt. So in the case of a mortgage, it's pretty simple when you're buying a house. When you go to the bank and say, I want to buy this house, the bank says, all right, great, the house is collateral. Should you choose not to, or circumstances cause you not to be able to pay back the loan, the bank can now come in and foreclose on that property and take it and liquidate it to regain the funds that they put out. And it's the same concept with business. We look to see what kind of collateral is there, if you have something that the bank can take if you do not repay the loan. Now, it might sound a little harsh, but the objective of any lender is never to foreclose on an individual or a business. It's actually a lot of work and a lot of red tape to go through that process. So they'd much rather you be successful and have the ability to repay, and they don't have to come after the collateral. Another C is conditions, and sometimes the organization might place conditions on whether or not, we'll give you the loan, but under these conditions. You have to do this, you have to do that, you have to do the other. Those are the conditions based on what we will do in order to make a decision on giving you the loan. And you can either accept those conditions or look for another route. All right, so let's go into some of the other considerations that lenders look at when making a credit decision. And those include like general and background stuff, like when did the business start? How is the business incorporated? If it's in fact incorporated, it can be different types of entities. You can have an LLC or a sole proprietorship or a partnership. These types of things tell us who's involved in the business and what percentage of ownership you have and what percentage of ownership you have, any investors, any partners. These types of things are important for us to know. What will the funds, this is probably the most important one when you go to uh, training for a bank. They train you to ask this question up front. It's one of the first questions you'll hear. What will the funds be used for? Right? It is important that you get the right credit facility for the right purpose. In some cases, uh, consumers or borrowers get the wrong credit facility, and that can get you into trouble if you don't use the credit facility correctly. Whether you get a loan or a line of credit or something else. If you are looking for something that's revolving and it's for short term, purely short term purposes, you're looking for something to, just make purchases, give you a little flexibility to be able to make purchases for small purchases, then the right facility might be a credit card. If it's something where you have a gap in your cycle where you you get paid from the people that pay you 90 days, but you have to pay your suppliers within 60 days, there is a gap there that you need to fill, and the best facility for that might be a line of credit. And then there's a loan where if you're buying something that's a specific thing, maybe you're buying some equipment to start a business, you want to start a business, you want to start a trucking business and you need to buy a truck, you need that money all at one shot, and that's probably a loan. That's probably the facility that you're looking for. Other considerations are, how did you determine how much financing you need? Did you just come up with a number? Is it just that, some people like round numbers, so they say, hey, $1 million is a nice amount, so I'm just going to apply for $1 million. I just like the way it sounds. Or $100,000. Well, you probably should have done some kind of homework and have some sort of method behind how you choose how much financing you want to apply for. Some other considerations. Uh, what personal or business collateral is available to secure the loan? We talked about collateral in the 5 C's, but what do you have that you can put up as collateral to secure the loan? Some lenders are less concerned with collateral and they're just more concerned with your cash flow and how much money you're making right now before they lend you anything. Others will look at things like collateral, and they'll look at your business plan and those types of things. And I'm sure the SBA is going to give you some more stuff on business plans and uh, how that plays a role. When the other area is the management and employees, right? So what does the management structure look like? Is it just you? Is it you and your partner? Do you have an investor? Is there a silent partner? Um, uh, and what level of experience you have in the business that you're looking to do? Like if you want to do a food business and you want to open up a restaurant or something, if you've never had any experience in the food business, simply because you can cook might not necessarily be seen as a good candidate for a restaurant. And in a lot of cases, restaurants fail at a very, very, very high rate. So we want to know what kind of experience you have and what will make your experience pertinent to being running a successful business. These types of things, you might have to go back to your tax preparer or to your bank to get. It would always be wise to have them in advance. So you're going to be applying for something, you know, get a couple of years of tax returns close by, get your bank statements, a couple of months, most recent ones, ready. Depending on where you are, get your taxpayer to prepare your financial statements and have it at the ready. So when you apply, you can get a decision a lot quicker with those things handy. Um, what other personal and business debts do you have? These are things that you need to know. Sometimes we start a process and then we realize that there's a judgment out there. If you have an unsatisfied judgment, very few lenders will lend to you until that judgment is satisfied. So you want to make sure that that's something that is handled pretty quickly. Do you have an accountant, a bookkeeper, a tax preparer, CPA, whatever you want to call them? These are all important members of your financial team, including your banker, and they can make or break a credit application if you have the wrong person who's handling your stuff, your taxes that were supposed to filed aren't filed, you miss deadlines, all these types of things can create a delay or maybe even a decline. Your personal credit score is one of the biggest indicators, because when you have a business and you don't have a track record, especially for startups, one of the biggest determinants of how you manage finances and how you handle your business is your personal credit score. Have you or your business ever applied for bankruptcy? That is something that's tough to overcome. From a conventional lender like a bank, we probably couldn't get a loan done if you had a bankruptcy within the last I'd say 7 years. If you are retired and you're on a fixed income, you have a certain amount of income coming in, that is income. That helps. Your income helps. You would also need to have, if this is a startup, right? So you don't have the laundromat yet, you're going to start a new laundromat. You have to have a pretty solid business plan with financial projections. Will give any lender who's looking at it the impression or the belief that your business is going to be successful. So the business plan and your credit score probably would be the most important aspects of it.
Welcome to Business Matters, a presentation of the Chamber Coalition, which comprises the New American Chamber of Commerce, the African American International Chamber of Commerce, and the Hispanic American International Chamber of Commerce. To become a chamber member, be a guest, or register for our events, go to www.nacc.nyc. That's www.nacc.nyc, or call us at 718-722-9217. That's 718-722-9217.